According to economic experts, a financial crisis is looming, and the new crash is expected to happen before the elections. Recent studies have indicated the many elements that will likely undermine the financial markets over the next weeks. And today, we're going to analyze those determinants and discuss how they're going to affect the next chapters of the economic collapse. Keep with us. Don't forget to like this video, share it with your friends, and subscribe to our channel if you haven't already. This month, Oxford Economics number crunchers set a new research group to question global business representatives what probability would they give that there might be a new financial crisis. The poll interviewed 162 associates of reputed worldwide companies, and the average answer was that they see a 20% chance of a new financial crash happening at some time from now until the next couple of years. That rate is twice as high as the perceived risk of a second global wave of health crisis-related cases, as well as the probability of an early arrival for an effective vaccine. And these fears have already resonated consequences, driving down business sentiment more in this month's Oxford survey than hard data could justify. Jamie Thompson, the poll's lead economist, said that their analysis suggests that financial crisis fears account for much of the gloom. This is a concerning factor for investors. However, if a financial crisis explodes right now, it wouldn't necessarily be configured like the 2008 crisis. At least two aspects of the present developments contrast to what we've seen in the past. The first one is related to the fact that the U.S. Federal Reserve and other central banks have made it clear that they will do whatever is necessary to keep markets functioning during the ongoing sanitary crisis. Events in March were an example of that. After the U.S. Treasury bond market halt, the Fed stepped in, providing extraordinary liquidity support. The second aspect is that banks are not the source of this year's economic collapse. In fact, banks seem to be much better capitalized at the present time in the US and most of Europe than in 2008. Senior Fed official Randall Quarles defended the move, affirming that large US banks entered the crisis in strong condition, and the Federal Reserve has taken a number of important steps to help bolster banks' resilience. In short, as Morningstar, a financial data group, explained it, the risk of insolvency and a capital crisis for the U.S. financial system appears to be much lower this time. Even so, as Financial Times puts, a financial crisis does not always materialize in the same way it did with the Lehman Brothers collapse. That is to say, sometimes financial stress arises in trickier ways. While some heatedly discuss whether this situation can be defined as a crisis, most market specialists acknowledge how chronic stress can be very economically debilitating, especially with so many economic vulnerabilities at stake. Carmen Reinhart, chief economist of the World Bank, observes yet another problem that haunts the finance world. The leverage at many institutions already was staggering even before the beginning of the sanitary outbreak, as she noted that if you look at financial sector vulnerabilities, in the longer term, it is difficult not to be pretty bleak. In addition to this, there is the remaining impossibility to calculate the scale of eventual credit losses from the global health crisis, while the virus-related cases continue to rise, particularly because the widespread policy of credit forbearance masks the real damage made up until this point. According to the chief economist of the Bank for International Settlements, Hyun Song Shin, although banks were not the origin of the crisis, they cannot expect to remain unscathed. The immediate liquidity phase of the crisis is now giving way to the solvency phase, and banks will undoubtedly bear the brunt. Even though big U.S. banks have expanded their reserves to deal with this situation, Reinhardt expresses her concern towards those in countries such as India and Italy, which may be less prepared. Also, the ultra-low interest rates deteriorate bank profitability, and another problem is that it is hard to forecast future risks because of the lack of historical precedent. Reinhardt goes on by stating that crises usually happen because of a boom-to-bust cycle, and investors know what that looks like. This is different. Considering that a lot more financial activity is flowing through the non-bank sector via capital markets, unpleasant surprises can emerge fairly quickly. For instance, the spark for the March halt in treasuries lay between hedge funds, a sphere less known by regulators than banks, and the implications to this point indicate that when interest rates surge again, much more distress could erupt in the financial sector. Evidently, such quiet deterioration will not receive the same attention in the headlines, given all the many other more immediate and more troubling pieces of news we have to cope with right now. But investors should keep in mind that if lenders start reacting to a furtive rise in defaults and, most importantly, fearing future stress, the outcome could tighten credit conditions despite central banks' policies. As Mr. Shin observed, surveys already show a significant tightening of lending standards. Similarly, Ms. Reinhardt confirms that a credit crunch seems really very likely. In that sense, it's understandable that Oxford found that fears about finance were poisoning confidence, and the odds for a V-shaped economic recovery are out of the picture at this stage. Likewise, Deutsche Bank disclosed to clients this week they can already see an increased risk of financial disruption down the road from the growing overvaluation of assets and mounting debt levels. Furthermore, Deutsche Bank gathered a team led by Peter Hooper, Global Head of Economic Research, to release the World Outlook Update, which predicted the pace of the recovery, or as we prefer to call it, the calm before the storm, to slow, as the viral cases will likely soar through the winter months, especially if another fiscal package isn't issued before the U.S. elections. But the team anticipates that when the summer comes around and the vaccinations start to happen, the prospects of a restructuration could resume. And presuming there is a successful vaccine, the team foresees 3/4 of the world's population could be vaccinated by mid-2023. However, don't expect the vaccine to fix the economy. Hooper warns the virus will leave persistent scars in the markets, such as long-term damage to the hospitality industry, and automation is likely to take jobs away for good, meaning that a full recovery to the economy to pre-sanitary outbreak levels may never happen. Also, the Deutsche Bank strategists, who can also see the looming financial crisis being formed by the growing overvaluation of assets, increasingly high debt levels, which were driven by the massive fiscal and monetary policy stimulus granted by the Fed, outlined that financial crises have often been touched off in the past under such conditions by the inevitable shift from policy ease to policy tightening, which is likely still at least several years away, but could surprise sooner. Conversely, the team called attention to the fact that politics may become a bigger threat than some might be considering, affirming they could see significant risks of not getting a quick and clear resolution to the general elections this time around, with a likely unprecedented share of mail-in ballots and delays in counting holding the potential for a contested election. In the same note, Analysts have been pointing out how Ruth Bader Ginsburg's passing hasn't been recognized yet as an event that will significantly raise the likelihood of the U.S.-centric financial crisis as well. The continued forbearance by lenders and bond trustees, the rule waiving, and the explicit belief in further fiscal stimulus have all depended on the assumption that Congress would be open to any negotiations between the parties, Financial Times noted on a recent publishing. The possibility of an agreement between the two parties was smashed by the fury that emerged among Democrats at President Donald Trump's persistence to appoint Ginsburg's successor before the election. For its part, Fed Chair Jay Powell keeps pleading for more fiscal support recently, despite Congress's failed attempts to urgently concentrate members seeking for an agreement on additional fiscal stimulus. Everything that matters in Washington at the moment is who is going to take Ginsburg's chair. In the meantime, there are entire industries, such as airlines, hotels, and retail, whose revenues are deeply suffering from the cutback of the initial federal fiscal stimulus and consumers' fears of the viral infection. All of these industries have been assisted by previously investment-grade tranches of securitizations that are now falling into large-scale default. In simple terms, the only way to get Congress to enact a massive new stimulus check before January or February will be through the eruption of a financial crisis. In normal situations, these crises are boosted by the failure of a major financial institution or the sudden, deep repricing of a whole class of securities. But considering what we have discussed before, as John Dizard explained in a recent article, the large banks are far more risk-averse and better capitalized than in the past crisis, and the housing industry is prospering from the refinancing boom made possible by Fed easing. Since the Lehman 2008 crisis, risk has been moved off bank balance sheets and into securitization markets. Which means, this time around, the crisis will be triggered differently, and strategists are signaling that the spark for the coming financial crisis will be the market's rejection of a few classes of securities in a similar fashion to the 1929 collapse of pyramided securities holding companies. Thus, to discover what the point of vulnerability in the U.S. financial markets could be, we have to take a look at the least legally flexible credit securities that can move the fastest from low risk to visibly defaulted, as Dizard stressed. And those would be the commercial mortgage-backed securities, or CMBS. As we mentioned in a recent video about the Big Short 3.0, the CMBX S9 BBB- tranche has an exposure to the hotel sector, which is the one presenting the highest rates of rental insolvency, paired with malls and restaurants. The tendency points for an acceleration on the deterioration of those securities to happen from now on, except in case of a miraculous liquidity injection is issued by next month. In any case, by then, the market will see more and more AAA tranches jumping down to BB. One of the same things that happened back in 2007-2008, when the last financial crisis started to speed up. Amongst the easiest targets of the byproducts of this crisis will be the major credit rating agencies, whose downfall will severely reverberate in the real economy. While the government keeps failing to assess the situation, this move seems to be a way out of the misery that the financial institutions are suffering. As Bill Blaine's forecast for the financial weather suggests, there is a storm fast approaching, and morale is tumbling as fast as the economic prospects. If you're one of those who still have hopes to see an economic upturn for this year, I'm sorry to disappoint you. but all things point to a bigger meltdown.